investing. Most people think of it as panic, stress, and constantly watching the stock market like it's the finale of their favorite reality show. But guess what? It doesn't have to be this way. In fact, if you're doing this, you're doing it all wrong. After studying countless investing strategies, reading more books than I care to admit, and finally testing them all out, I found the one strategy that beats 99% of investors. It's simple and it's used by the best investors in the world. And spoiler alert, it's not sexy and it doesn't involve screaming at your screen.
Stop screaming! Stop!
Okay, let's get one thing straight. There's no such thing as a no-risk investment. Be it an index fund, ETF, gold, stock, or whatever, I don't care what your cousin's friend who totally understands crypto tells you.
Cryptocurrency, it's up and then it's down. It's like erectile dysfunction. You want it up here, but at the end of the night, it's right here.
Every investment carries risk, and if you can't stand the thought of losing some money, then maybe investing isn't your game. That's why you should only invest money you're comfortable losing. I'm talking spare money and not your rent money.
You lost all our money?
Point of order. I didn't lose all the money. There was enough left for this cowbell. Damn you, eBay!
Now, this doesn't mean you're going to lose everything, but the mindset really matters. Once you've made peace with this, you can freely invest with a cool head, because you don't want to tie your emotional quotient to the stock market. Because fundamentally, why are we investing? To get your money to make you more money while also sleeping peacefully every night. Another important thing to get out of the way, most investors are terrible. I'm not throwing shade, it's just facts. They're always chasing the next big thing, trying to guess when the market will crash or skyrocket. But in reality, they have no clue. And it's not their fault because no one really knows. Imagine you're at a casino and you know that one guy at the blackjack table who's super confident going all in, doubling down every hand, and then losing everything.
20 beats your 5. I'm sorry, sir.
Yeah, that's most investors. And so instead of gambling, what you need to be doing is playing the long game and coming out on top. Don't confuse day trading with investing. Let's say you're on board and you decide to start investing, or maybe you've been investing for a while now. You really don't want to be this person. You don't want to be glued to your screens, checking your phone constantly, studying your charts like you're trying to crack some code. But here's the thing, that's not investing. That's called trading or day trading, and what we instead need to do is investing. Putting your money into solid long-term growth strategies and then going about your day and not having to worry about whether or not Tesla is going up or down by 2%. So stop spending hours trying to predict the market. Investing is and should be an inherently boring thing to do. It's like watching paint dry and it takes some time.
I'd rather watch paint dry.
Nice.
So if you're stressing about it all day, then you're definitely doing something wrong. Separate your cash. Here's a quick but important one. Always separate your liquid cash from your investable cash.
I will open your eyes and you will see just how deep the rabbit hole goes.
So what's this liquid cash? That's the money you can grab at any moment for emergencies, bills, whatever. And your investable cash, on the other hand, that's the money you're putting to work in the market. Mixing these two up is just a recipe for disaster. And like I've been yapping away on this YouTube channel, before you even think about buying a stock or an ETF, make sure you got your emergency fund and savings covered. My not so simple trick, the opportunity fund. So there are two portions to my investable cash. First portion, I dollar cost average into the S&P 500 every month. This is a smaller portion of my monthly investments. And the bigger amount is what I use to build my opportunity fund. Because while the former strategy works, and we'll talk a little bit more about that later in the video, I'm not a fan of just blindly throwing all my money into the same investments every month, like some people do with SIPs. Okay, so what exactly is an opportunity fund? Basically, any additional investable amounts you have decided to invest in the market, but not actually use to buy any asset yet. Which means you can decide to keep this in a different savings account or transfer it to your Roth IRA, 401k, TFSA or RRSP or whichever account. And then I use this money when the opportunity presents itself.
Just be patient.
This is in stark contrast to following the SIP format where you're dollar cost averaging every month by investing into an asset. And since I use a good portion of my investable amount to buy individual stocks, I notice there are many buying opportunities that presents itself regularly. I also use this ETF called Cash ETF within my investment accounts, which basically pays out a dividend of 5%, no questions asked, and the stock really doesn't fluctuate either, and it helps me make a little bit of money while I'm waiting for the right investment opportunities. It's almost like keeping your cash warm, ready to jump in when something good comes along. But again, you don't need to invest it anywhere. You can just leave it in the account, and when the opportunity presents itself, just go for it. Because let's face it, not every day is a good day to invest, and this strategy has worked wonders for me. And since we're talking about finding opportunities in the market, that's a good segue into not timing the market, but instead being smart about it. Let me get this clear. I don't try to time the market. I'm not a fortune teller with a crystal ball.
Tell me the name of your favorite animal. 1, 2, 3. Elephant, squirrel.
But here's the key. I do buy low and sell high, but with set triggers in place. I spent some considerable time understanding the market, the trends, balance sheets of companies, quarterly reports, to shortlist a bunch of companies that I personally believe in, backed up by facts and numbers. And that's the thesis to my investing. And I'm not guessing when to buy or sell either. I've got alerts that help me jump in when prices drop or sell when they've hit a solid high based on the research I've done earlier. But the selling bit when the stock hits a solid high rarely applies to me because I'm in this for the long run. And since most of my investments are in market compounders, I don't sell any of my investments, or at least I've not had to sell anything up until now. Knock on wood. So yeah, it's not about timing the market. Like I said, it's about being ready when the market presents an opportunity. Keep it simple, keep it passive. Okay, so if you're really lazy and don't want to do anything that I'm doing here with the research and all of that, then do a very simple thing. Dollar cost average into an index fund or an ETF, like a broad index. That's it.
Are you serious?
No, seriously, that's just the strategy. I know it's not as exciting as day trading, crypto, or buying the next hot stock, but the best investors in the world like Warren Buffett and Jack Bogle, they all swear by it. Although this is not the bigger portion of my investments like I mentioned earlier, I definitely do invest in the overall broad index as a hedge to the riskier investments I make in the market. And here's why. These ETFs track the entire market. They don't try to outsmart it, they are the market. And guess what? The market always wins in the long run. The numbers and trends also clearly show that the S&P 500 averages about 9 to 10%, which is a solid rate to grow your money. Let me give you an example. If you were to simply invest $5,000 per year into the S&P 500 for the next 30 years, you would have contributed a total of $150,000. But that would have grown to almost $1 million in total, meaning your 150K accrued an interest of more than 800K. That is freaking insane. Compound interest, motherfishers.
Wait, what did you say again?
By staying in the game with an index fund, you're basically making money by doing nothing. Building my portfolio quickly. So when I started implementing the strategy I mentioned, I started doing fairly well in terms of returns. I mean, they look great. It was around 20% CAGR in the first few years. But here's the catch. It didn't matter much because I was only investing small amounts. In the grand scheme of things, those small percentages don't add up to much unless you start increasing the amount of dollars you're putting in. While initially I was testing out my theory, learning about the market and figuring out a strategy that worked for me, now, of late, my plan has been to increase the amount I invest. And I'm saying drastically increasing the amount. Those early days were just practice, and now I'm aiming to build my portfolio quickly by putting in more cash and not just banking on the returns alone. I'll link my investing playlist for you to check out at the end of the video so that you too can start increasing the amount you invest in the market. Don't withdraw. Keep your cash liquid. One final thing, and probably one of the most important things that you should keep in mind: don't touch your investments. I mean, seriously, leave it alone.
Just please leave it. Just please leave it alone.
Remember, time in the market beats timing the market. If compound interest needs to kick in as the eighth wonder of your world, then you need to let time do the heavy lifting for you. And I mentioned this in so many of my previous videos, but you need to have liquidity for emergencies and expenses so that your investments are not disturbed. And the idea is to let the money work for you and not the other way around.
You bring in your money, it meets other money, mates, and makes more money.
Not for you to constantly keep refreshing your app every day to see if you have lost money or made some. Again, it's all about time in the market and not timing it. And once you start pulling money out, you're breaking the golden rule of long-term investing.
Never break the rules.
I'm gonna dive deeper into this in my future video where I talk about the specifics, numbers, and how much I keep aside for investing every month, how much I put into expenses, savings, etc. So if you'd like to check it out when it drops, then consider subscribing. Okay, so these simple yet super effective strategies have helped me beat the market consistently and, more importantly, sleep well at night. Don't forget, lazy investing is the real hustle. But strategies at the end of the day are just theories. And so for you to achieve your investing goals, I'd argue that the practical steps are far more important. And so check out this video where I talk about how I invested more than $25,000 in less than a year. I'm certain it's going to help you. Also, if you need to considerably increase the amount you're planning to invest in the market, like I'm planning to, then you need to have more money to invest. Duh. And this playlist will 100% help you make more money. Thanks for watching, and I'll see you here or here. Your pick.
Don't want nobody else around. When I'm with you, baby, nothing really matters.